Well, as second quarter earnings wrap up for big U.S. companies, our next guest says recession fears are lingering, but fewer companies are seeing significant profit declines. He also has picks in the technology sector. Let's bring in Drew Pettit, U.S. equity strategist for Citi Research. Drew, thanks a lot for joining us. Why don't we begin with NVIDIA, one stock that you follow closely. It was the star of the week with those results on Wednesday. What's your take on the trading we've seen since then?
Hi, Paul. So thanks for having me. And NVIDIA, anyone watching U.S. stock markets has to pay attention to that stock. So look, heading into the print, implied growth expectations were really high for the stock. To us, we think the market was pricing in about $5 of free cash flow per share, looking out 5 years. And honestly, the bottom-up consensus isn't there yet. Let's call it 4.25 right now. So when you have that really high implied growth setup, it means you have to aggressively beat and raise every quarter for stocks to keep working in that linear type fashion. So NVIDIA posted a decent quarter, didn't really mess with its full year guide for 2024, but it wasn't perfect. So you saw a little bit of a sell-off. I would say a pretty normal move and something we expected headed into the print.
You say that stocks where you see companies being able to reach long-term fundamentals include Apple, Amazon, and Google. What does that exactly mean, attaining long-term fundamentals?
Yeah, so to us, we spend a lot of time trying to figure out what the market is pricing in, not what analysts are telling us what they think long-run expectations should be. So for all of those stocks, the market is pricing in a level of growth over the medium term that the current consensus estimates say we can at least meet, if not beat. So that means there's less pressure on those stocks to be perfect on every quarterly earnings call. So again, Apple, Amazon, Alphabet all have a much better setup than a darling like NVIDIA does.
What's your take on S&P 500 earnings now that they are essentially complete?
Yeah, so honestly, a lot of what we expected, a little bit of a bore for the summer. I guess it doesn't make really great TV for you, Paul, but we had a normal level of beats. It's just how it goes. Companies tend to beat by a couple dollars every quarter. That's very average when you look back in history. That's what we got. But stocks had run a lot heading into this print, heading into all of these prints. So what we expected was managements to kind of temper expectations and lower the bar for the second half. And that's what they did. So they beat Q2 by a couple of dollars, but didn't move full year estimates. So as expected, we still think the earnings picture is really solid going into the last quarter of the year.
Will we see this rotation into small cap stocks that a lot of people think we will see, small and mid caps, and that we did see early in August, but it didn't last very long?
Yeah, so we've always talked about U.S. small cap being the ultimate soft landing trade. So we're getting closer to that Fed pivot point. Our economists think that's upcoming in September. So that does support small cap. But the other part of soft landing and being a small and mid cap investor is getting earnings growth when you go down cap into smaller, riskier stocks. That earnings growth inflection for SMID is about to happen. And by Q4 results and into Q1 2025, we should start to see premium earnings growth from small cap. So we think you want to start legging into that ahead of that fundamental change.
We hear from a lot of professional investors. In fact, we heard it just a few minutes ago on this channel that cautioning against buying a small cap index. There are too many inferior companies in an index of U.S. small cap stocks like the Russell 2000, which has 2,000 of those names in it. Do you agree? And if so, what should investors look for when they do their homework in the small cap sector?
We always joke about this because before we started doing U.S. equity strategists, we were ETF specialists. And small cap, the mantra has always been know your index. So yes, the Russell 2000, very messy. A lot of companies that were large cap companies, mid cap companies have kind of fallen into small cap. So you have a messier fundamental setup there. But if you look at some of the S&P 500 indices, they have profitability requirements to go into the index. So when we think small cap, we actually think about profitable stocks. We think about higher quality stocks. And we think that is probably a better way to express the small cap view. So to your earlier guest's point, Russell 2000 might not be it unless you love a whole bunch of small banks and biotech stocks. But the S&P 400 and 600 for small and mid cap exposure might, I would say, fit portfolios a little bit better.